Ladies and gentlemen, good morning and welcome to the second JSE Small Caps Investment Forum for the year 2022. My name is Langa Mangale and I'm the head of equity and equity derivatives at the JSE. I am honored and excited to join you this morning as we shine the light on small cap companies. At the JSE, we are acutely aware of the importance of small cap companies and we are committed to support you to access investment capital and leverage the JSE as a strong platform for future expansion. For this reason, annually, the JSE hosts the Small Caps Investment Forum as a platform for small caps and a channel to engage with investors to share ideas on growth strategies. This investment forum is one of several initiatives that we have in our arsenal aimed at profiling small caps for the benefit of investors who may wish to either diversify their investments to include exposure to companies outside of the large cap or just to benefit from the growth in small and medium-sized companies. For good reasons. The focus on unlocking growth of small caps is confined to regulatory and policy issues, but less so on secondary market challenges around liquidity of the small cap sector. As you may know, liquidity begets liquidity. In this regard, the exchange is investigating, and I might add, quite excited about an ongoing work on mechanisms to improve liquidity in the small caps through a sell-side market-making scheme. The market-making scheme will aim to attract and incentivize brokers to provide liquidity on small caps, thus ensuring tighter spread and less unwarranted volatility auctions typical of liquid stocks. With coverage, visibility, and awareness, we hope to attract more investments and trading activity in the small cap sector to provide an impetus for the sector's performance as demonstrated last year. In 2021, the small cap index outperformed the mid cap index by 25%. Year to date, the JSE small cap index has been more resilient than its main rivals, falling only 3.74%. Versus a decline of 7.95% and 9% respectively in the mid-cap and JSE all-share indices. Of course, investing in small caps does not come without risks. No investment does. There is much more volatility than in large caps. However, there are small and medium-sized companies with strong balance sheet, robust margins, and a strong prospect for the future. These are the family jewels. Today, the event is an invitation to support small caps that have the potential to become medium and large caps of tomorrow. Before we kickstart today's proceedings, I would like to take a moment to thank the executives of the companies that are joining us this morning. Stefano Marani, CEO and MD of Renigen, Alan Solomon, CFO, Capital Appreciation, Johan Odendal, MD, Southern Palladium, Samara Totaram, CFO, Stadio Holdings, Quintin Rossi, CEO, Spearrate Limited. Thank you for making the time to be with us today to showcase your respective companies. And a big thank you to everyone who has tuned in. We invite you to immerse yourself in today's discussions and to share your valuable experiences and insightful ideas.
Welcome to the JSE Small Caps Investment Forum. I'm your co-host, Bright Kumalo, aka the one and only and multi-talented number one dividend papi. If you're watching this on YouTube, be sure to drop us a like, and followed by your favorite emoji. Right now, ulindele bani. Many people in the investment circles ask me if the small firm effect works in real life. The small firm effect, you ask, refers to a theory that predicts that companies with smaller market caps tend to outperform larger ones. My answer is always an enthusiastic yes, of course. And according to the white paper titled Size Matters, If You Control Your Junk, by the bright minds at AQR, when it comes to equity investing, size matters, and in a much bigger way than we previously thought, but only if you control for junk. Junk, in this case, being, small, low quality, highly indebted companies. If you control all of that, a much stronger and more stable premium emerges that is robust across time. The quality of a firm helps clean up the relation between size and the cross-section of expected returns. With that in mind, today we'll be joined by a few JSE-listed small-cap companies to help us adjust for quality exposure and maybe enjoy spectacular returns in the long term. Remember, small is beautiful. Patricia?
Thanks, Bright. Good morning to all of our viewers. It is great to have you all online. We are super excited to be hosting the third Small Cap Investment Forum since we initiated this initiative. We have a great lineup of speakers for you today, and I am thrilled to have Bright Khumalo as my co-host, who will be asking all the difficult questions. The format for today is, well, we have 5 companies presenting their overview, and thereafter we will go live into Q&A. CPD points will be allocated, so please do email zia@iassa.co.za with your name, surname, and ID number. Our first presenter for today is Quinton Rossi, Chief Executive Officer of Spear REIT Limited. The JSE REIT sector is trading at an average dividend yield of about 8% and still somewhat recovering from the 2020 lows. Over the past year, listed property yielded a return of 15.5%, followed by general equities of 11%, bonds by 5.6%, and cash at 4.1%. Spear REIT Limited listed on the JSE on the 11th of November 2016 as a real estate investment trust on the ALTIX of the JSE. Its main business is investing in high-quality income-generating real estate across sectors within Western Cape, predominantly in the Cape Town region. The company successfully moved to the JSE main board on the 22nd of May 2017. We have Quinton in studio today to tell us more about where they are today, but before we cross over to Quinton, let's share Spear REIT Limited corporate video.
My name is Quinton Rossi, co-founder and CEO of Spear REIT Limited. Spear is the only regionally focused real estate investment trust listed on the Johannesburg Stock Exchange. We obtain our specialization through exclusively investing into high quality assets within the Western Cape, and our diversification through asset type investment into industrial, commercial, retail and mixed use assets with a distinct bias towards the Cape Metropole. And the ambition is to grow this business from its current valuation of about 4.5 billion to 15 billion to become a meaningful mid-cap. Spear's mission statement is to be the top performing REIT within the Western Cape, to grow our distribution ahead of inflation on an annualized basis, and to operate within the top quartile of our peer group. Since inception, Spear has operated with a 94 to 95% occupancy rate. We have consistently navigated through the COVID environment, and we are well positioned for growth in the years ahead.
Quinton, welcome to the studio. Great to have you up in Joburg from Cape Town. Hope it was a good flight.
Yeah, thank you. Appreciate the invite. And flight was good, flight was full, so things looking to be returning back to normal.
Fantastic. Well, why don't you take us through your presentation for today?
Thank you. Morning, everyone. And thank you for the invitation and for us to showcase our business, Spear REIT, to you this morning. Just having a look at our introduction. So Spear was founded as a Western Cape focused real estate investment business by well-known industry veterans Mike Flax, Abu Barachia, and myself in 2011. Our focus was to be a hands-on Western Cape focused investor, given the fact that we believed that being close to our assets was going to give us a competitive advantage to other property owners within the Western Cape. And we started out life with a 72,000 square meter portfolio with an asset value of about 354 million rand. We have historically, and even in our listed life now, obtained our specialization through regional investment into high quality assets within the Western Cape. Our diversification is obtained through the investment across asset types, being high quality industrial, convenience retail assets, commercial assets, mixed use and hospitality assets. As Patricia mentioned, Spear listed on the JSE in 2016. We listed a 1.4 billion rand Western Cape focused diversified fund as a real estate investment trust. Spear's portfolio has continued to grow in both quality and value over the years. Currently, the Spear portfolio has an asset value of about 4.48 billion rand, comprised of 457,000 square meters Spear's portfolio has historically and continues to have a very strong bias towards high-quality industrial warehousing and multi-let industrial parks. Spear is a fully internally managed REIT where we do everything from our financial management, development management, and asset management all internally. I am joined by an incredible executive team back in Cape Town, our CFO, Christian Barnard, our Chief Operations Officer, Cliff Tureen, and our Chief Investment Officer, Kim Cog. So having a look at our journey, I've touched on briefly on the inception story. You will see that around 2016, the listing on the JSE took place. We doubled the business in asset value from between 2016 and 2018. Growth then went to from 3.13 billion to around 4.1 billion prior to the onset of COVID. With the onset of COVID, we, like most businesses, refocused internally, ensure that we had tenant and rental preservation. We are now exiting that COVID period, and we believe that the business is now well positioned for growth as we navigate through into the FY23 financial year. Having a look at our mission statement. So Spear's mission statement is to be the leading Western Cape focused REIT, to operate within the top quartile of our peer group, and to consistently grow our distribution per share ahead of inflation on an annualized basis. From a strategy perspective, our strategy is to continue to be value investors within the identified asset types that we acquire using our asset management initiatives to increase asset value in terms of capital value, as well as strengthen our net cash flows. We will remain an authentic, consistent dividend-paying income fund. We will focus on owning and managing high-quality assets within the industrial, convenience retail, and commercial asset type, focused on fixed income to our shareholders. We'll continue to prudently recycle capital on identified assets where we believe that we've achieved maximum shareholder value. Our hands-on asset management strategy has paid off. If you have a look at our track record, we've always maintained high portfolio occupancy rates together with a very high tenant retention rate on an annualized basis, giving rise to consistent and growing cash flows for the business. And one of the keys to Spear's strategy is to provide that sustainable income, but also to execute against our smart strategy, which is that specialised within the Western Cape, managed internally. We're doing yield accretive acquisitions. We redevelop existing portfolio assets to get organic growth coming through into the portfolio and to timelessly execute on our tenant retention strategy. So having a look at more granular details on the business, the portfolio is comprised of 31 high-quality Western Cape-focused assets, portfolio value of 4.48 billion. Our average property value is 143 million rand per property, which translates into a 9,669 rand per square meter valuation, which is something that shareholders should take note of, that you can acquire a stake in Spear at under 10,000 rand a square meter, which is well below replacement cost. Our in-force escalations, which is effectively how our rentals grow on an annualized basis, is 6.31%, and our occupancy rate, as I've mentioned, is maintained at the upper 90+%. And then something that became pretty top of mind with COVID was our cash collections. We've maintained very strong cash collections over the period, with about 98% of our rentals being collected on an ongoing basis. We've recently reported on our FY22 results. Spear achieved a 16.26% growth in our distribution per share, which was well ahead of our forecast. With the strong cash collections, we improved our payout ratio, which brought us to an average of 88% for the year. Our tangible net asset value, net of distribution, is 10.95 rand per share. Our shares in issue, excluding treasury shares, is 234 million shares, and our market cap currently is around 2 billion rand. Our balance sheet, strong and robust and well positioned for growth, with an LTV or loan to value of 39%. We have a fixed debt ratio of just over 67% and growing as we continue to move out of variable debt exposure. We have a very well structured debt expiry profile, which we believe is robust, which provides limited to zero refinancing concerns for the business in the short to medium term. Having a look at our portfolio, Our view is that we take a less is more approach. So in order to be active hands-on managers of our assets, we believe that owning fewer assets, but assets of higher value, is a key part of our asset management strategy. As you'll see, our top 5 assets comprise 47% of our portfolio value. It's also a great display of diversification, from our largest asset being a multi-tenanted industrial property occupied by blue-chip tenants, and all the way through to our mixed-use retail assets in Sable Square, our Liberty Life head office in Century City, and a high-rise financial district, Cape Town CBD office building. Having a look at our sectoral spread, one thing that I'd like to point out is from a gross lettable area perspective, a great moat around our business is that 56% of our portfolio is made up of industrial, which has been a fantastic moat around, especially the last 2 years, where our industrial portfolio has performed exceptionally strong with our convenience retail portfolio. Portfolio occupancies across the board, if you look on the slide on the right-hand side, you'll see that we've maintained a 94% occupancy rate. And yes, commercial offices are under pressure, but we're very, very pleased to have just under a 90% occupancy rate within our office portfolio. We believe we take a people, planet, profit approach, so we believe that sustainability is also key to our strategy. Our aim is to have 52% of our portfolio covered in PV solar. Currently, we are closing in on that. We've got 2 more projects to conclude, and we would have 52% covered with PV solar. It is the best business case from a renewable energy perspective, and this will form part of our strategy going forward. Having a look at the investment case, it was touched on earlier. Spear provided the market with an 83% total return for FY22. We outperformed the SA All Prop, we outperformed the SA REIT index, and we outperformed the small cap index by quite a margin. We do see that the trade ratio in our share needs to pick up. So we encourage you, if you like what you've seen today, to have a look into our business, reach out if you have any specific questions, and we're happy to talk you through any specifics. But just moving into the why would you want to invest into our business? We believe that we have a very strong business that has a consistent dividend-paying philosophy. We have a simple capital structure, easy to understand income statement, straightforward balance sheet. Our distribution reconciliation is easy to understand, from the expert investor to the novice investor. Our balance sheet is lowly geared and well positioned for growth. We are 100% invested in the Western Cape. This is, in my opinion, the investment case for South Africa from a macro, provincial and municipal infrastructure perspective. We've displayed market-leading occupancy rates as well as tenant retention rates over the last 6 years. Our portfolio valuations are robust. We don't provide for any bulk, so there's a lot of NAV uplift. And we have a proven track record to shareholders how we've exceeded our market guidance over the last 6 years. And we are on a very well and realizable path to achieve our mid-cap growth plan of around 15 billion in assets with a 9 billion market cap. Thank you very much.
Thank you so much, Quinton. Thank you for that presentation. I saw Bright making a whole lot of notes, so I'm sure that he has a lot of questions. We do have some questions coming in online, so if I can also just remind everybody online, please do submit your question via the YouTube link, and we will also bring those up. Bright?
Yes, the Spear story is a very interesting one, considering that, it's a small cap. We've passed COVID, and so I have a few questions here for you to show us basically your secret sauce and how you made it through COVID. So did you see any benefit of, well, first of all, walk us through the thought process behind of why you chose to do all of the management yourself in-house instead of outsourcing it like normal big REITs? And do you see a benefit to that during COVID?
Yeah, I think there's being close to your assets, both from a property management and an asset management perspective, definitely has given us what we would say a competitive advantage over our peers. During the onset of COVID in particular, we were able to engage immediately and actively with our tenants, which created what we would call that kind of cash flow support or cash flow bridge, where tenants could meet their obligations to Spear, and Spear could meet its obligations to our tenants. Now, when you look at an external management approach, there's a lot of kind of communication gaps that can happen, especially at the onset of a crisis.
Yeah.
So for us, being close to our assets and close to our tenants has always been a key part of our business model.
Yeah, I could only imagine the benefits there. So COVID, for many people, depending on which side you were, if you had cash, you could do acquisitions, and obviously if, you were smaller and you didn't have cash and you needed bailing out, you were a target. So what did you do to your property portfolio during COVID? Do you see opportunities to grow it? Do you see it, to cull some assets that were underperforming? Because I know for a fact that you did sell, one of your hotels in Woodstocks, and just walk us through your thinking, during the fires, during the madness, and
Yeah, I think our immediate focus was rent preservation, cash flow preservation. We were quite fortunate that we had just exited a disposal pre the onset of COVID, so we already had a relatively robust balance sheet. That additional cash into the business was set aside for the kind of unknowns, because COVID really kind of was like a fog descending on us, all of us across the world, not knowing where we were going. So for us, it was basically, just focusing on, getting our tenants through it, as well as getting the business through it. From a liquidity and solvency perspective, we built models and scenarios. Our CFO sat up day and night building apocalyptic scenarios, which thankfully never came to a fore. But what was also important was the role that the banks played in this COVID environment. We foresaw, at the early stages that there were going to be some headwinds, and little did we know the impact of what COVID would be. We met with our bankers. We said, guys, we want to keep the cash that we have available from our disposals. We don't want to pay down any debt at the moment. We're going to keep it as liquidity availability in the event of it being required. Our bankers, being Nedbank and Standard Bank, were very supportive, and I think kind of hats off to the banks and the kind of real estate industry network that kind of really helped all the property companies navigate through the COVID environment. Also, fortunately, our portfolio, as I mentioned, had about 56% exposure to industrial and convenience retail. So a lot of our tenants actually could trade from level 5 lockdown all the way through. The office sector was slightly more impeded, obviously. But, we have contracts for a reason, and, there are negotiations that take place between landlords and tenants, and you find a way to restructure, because effectively tenants are shareholders in our business and we technically shareholders in theirs. And it was just imperative for us to kind of bridge that during that period.
We do have an online question, so why don't we maybe ask one of those? One of our viewers is asking, what is the percentage of stock held by management? How much skin is actually in the game?
Yeah, so from a founder's perspective and management, we still own 28% of Spear. I think it's a fantastic display of alignment with shareholders' interests, because when we make an investment, we know that our own money is at play, and generally shareholders can rest assured that when we make an investment or do a development, that if it's good for management and for the board, which still consists of myself and 2 of our founders, that it's really going to be good for shareholders.
Yeah, fantastic. We have another very good question here on, one of the viewers at home, which is Keith McCacklin. Said, what's the average cap rate used in valuing your properties?
Yeah, so if you have a look at our recently published integrated report, on an average basis, it's just under 9%. From a cap rate perspective, and that's on a fully diversified portfolio. So we actually one of the few REITs that on a per property basis report our cap rates in the integrated report.
Fantastic. I mean, you touched briefly here with your LTV being at 39%, which I think is very conservative considering where most of the big boys sit, closer to 50%. So why so conservative? And obviously, can you expand further on the maturity of your debt, in the coming 3 years, because that's what usually matters the most.
Yeah. So I think as a smaller fund on a growth journey, shareholders, do take comfort in the fact that you've got a robust balance sheet. We believe that maybe 38, 39% might be a little bit on the lazy side. But what we do is we position that balance sheet for growth. So now we're happy to operate between a 38 to 43% LTV, which means that there's still scope to take on additional portfolio debt, as we find growth opportunities. So we're very selective as to which assets we acquire, because Spear has never had an external manco, so the incentive has never been to just grow assets for fees. The incentive for us as a management team is to grow our income per share on an annualized basis. From a debt maturity perspective, we've refinanced almost R1 billion worth of debt in the last 12 months on very favorable rates. Our CFO, Christian, has done an exceptional job. We have about a debt maturity profile of about almost 3 years, which is quite evenly split, about a third. And we don't believe that there's any refinancing risk, and it's quite a robust profile. Our funders are consistently asking us to take on more debt, which is now that we believe that valuations, because that's also very important to mention, is that we only had a 2 million rand devaluation of the entire portfolio in FY22, which means that devaluations from our perspective really have troughed out, which means that we can now start to see the way forward to fair value adjustments, increasing the valuation of the portfolio, which naturally reduces your loan to value, which again allows you to position the business for additional growth.
Okay, thank you very much. I think it's a wrap from here. I'm being told we're over time. Patricia?
Thanks so much, Quinton. Thank you so much for coming into the studio. Great to have you here. Enjoy your trip back to Cape Town.
Thank you very much.
Now to introduce our next company, Capital Appreciation, listed in the technology sector, a total market capitalization of 2.2 billion rand. Capital Appreciation listed as a special purpose acquisition company on the JSE, raising 1 billion rand through a private placement of shares in late 2015. Since then, it has made multiple acquisitions. Today, the company is operational in South Africa and has an office in Amsterdam. Today, we have Alan Solomon, who is the Chief Financial Officer for Capital Appreciation, to tell us more. But before, let's cross over to their corporate video.
With technology, there is endless opportunity. But it takes vision, expertise and skills to bring opportunity to life. At Capital Appreciation, with an eye for opportunity and a proven track record, we invest in and grow businesses that deliver compelling, innovative and disruptive solutions. With over 400 expert employees, we serve a large, high-profile client base across 20 countries, partnering with global leaders. Our growing businesses include multiple companies in our pioneering software and payment divisions. If you've banked, shopped online or used your mobile phone, then you have already experienced our award-winning software services in one form or another. With over 277,000 of our payment terminals in the hands of our clients and significant growth demonstrated over the past 5 years, our payment division is not only thriving, but is responsible for introducing first-in-Africa payment technologies that are now being used across the globe. But technology should create equal opportunity. This is the reason we invested in GovChat. GovChat is a platform that connects millions of citizens to government. At Capital Appreciation, we partner, we innovate, we execute.
Alan, great to have you in studio. You didn't have to travel too far today because you are based in Joburg, but it is great to have you here and we look forward to hearing about, more in terms of your presentation.
Good morning, ladies and gentlemen. Thank you for your interest in Capital Appreciation's history and future vision. Capital Appreciation is a business-to-business fintech group serving and partnering with banks, insurance companies and other large corporates. We listed in 2015 and we acquired our first operating companies in 2017. We have 3 divisions consisting of 8 subsidiary companies and 4 investments in associate companies. The group provides payment and specialized software products and services, and our 427 employees now generate more than 800 million rands in revenue and 250 million rands of EBITDA across 20 countries. We have a large and diverse base of well-established and successful local as well as international clients. This client base continues to grow due to our much sought-after products and services. The COVID pandemic accelerated everything digital, and that has created very significant growth opportunities. The acceleration towards digitalization and cloud services is due to corporates' increased understanding of the strategic importance of being digital, as well as consumers' demand for digital products. Capital Appreciation had a number of highlights during the 2022 financial year, delivering very strong financial results. We took full advantage of the demand for our products and services and delivered exceptional top line and profit growth in our 2022 financial year. We have a strong belief that lasting success stems from a strong focus on client and service excellence, innovation, and adding tangible value to our clients, and we live those values every day. For the 2022 financial year, we delivered growth in HEPS and dividends per share in excess of 30%. We have a significant cash pile of more than 530 million for organic as well as acquisitive growth opportunities. We have also built up a strong pipeline of contracts for the next financial year, some spanning over several years. We were pleased with the strong revenue growth, which was up 34%, which manifests itself in good improvements in EBITDA, up 46%, and a 54% increase in operating profit. A defining characteristic of Capital Appreciation's portfolio is that our businesses are all asset light and are also very highly cash generative. That has allowed us to deliver a 5-year track record of sustainable growth in dividends. In those 5 years, the group generated operating cash flow of 999 million rand and paid dividends to shareholders of 374 million rand, or 26.25 cents per share. I now refer to payments highlights. We grew our terminal payment fleet to 277,000 terminals, which generates annuity-style revenue from maintenance support fees and value-added services. The payment division has generated compound terminal growth of 41% per annum for the past 5 years. We also have a very encouraging pipeline of terminal orders for the 2023 financial year. We are experiencing a strong and growing market for payment terminals, whether they are actual physical terminals or linked to other devices such as cell phones. We provide all these options to clients. Our growth has initially revolved around a large corporate client base. However, as devices get cheaper, there are significant growth opportunities in the small and micro business sectors as well. I now refer you to our software highlights. Synthesis has made a considerable investment in infrastructure and IP in the software division, and Halo is one exciting outcome of this investment. Halo is a tap-on-phone app which allows payments from our own cell phone, and Halo's technology utilizes the features and benefits of Android terminals. Synthesis is one of the few companies in the world that is certified by all the major credit card companies to provide this type of payment offering. There is a significant interest locally and internationally for this exciting product. Our software business has a strong skills base that have won multiple awards for their innovative products and services. We have generated strong business growth, 300 million in new medium-term contracts during 2022, which will continue to deliver revenue for multiple years. The growth in the software business is supported by the significant increase in demand for cloud projects, and the software division has embarked on an international expansion and has already grown in international revenue by 33% this year from a small base. The software business stays at the forefront of innovative technology with 8 well-defined operating units, from cloud and digital services to cryptography and intelligent data. These different focus areas are all in high demand and provide diversified revenue streams and sustainable top-line growth. Our software division continues to implement commercial applications using in-house developed technologies for the benefit of its clients. The market for cloud products is massive, estimated at $1 trillion worldwide. Synthesis is a skilled and highly regarded provider of cloud services, as is particular with Amazon Web Services, the largest provider of cloud services globally. New acquisitions are strengthening the group's trajectory. Capital Appreciation has invested in several fintech companies in recent times in interesting high-demand areas of technology, which are synergistic to our existing businesses. These acquisitions will provide further avenues of growth for the future. The acquisition of the Responsive Group in March 2022 has already been successfully integrated into the group in a short time frame. Capital Appreciation has been involved in enterprise development initiatives since inception, with one of the major recipients being GovChat, which is the leading platform for citizens and governments to engage. GovChat was instrumental in the registration of social grants during COVID and has been recognized as AWS's Social Partner of the Year. The platform was developed by Synthesis. Capital Appreciation's positioning remains strong. Our healthy balance sheet enables management to focus on execution. We have experienced executives and a formidable skills pool. We own deep domain expertise and proprietary technologies in high demand and in high proprietary areas. This has become an accelerating imperative for economies to digitalize in large and growing addressable markets. Our products and services have demonstrable global appeal, serving a client base which consists mostly of larger, more resilient and essential businesses. We have asset-light and cash-generative business model with efficient working capital management and a large cash arsenal to pursue organic growth in our current businesses and make synergistically aligned acquisitions. While challenges exist and operating conditions are tough, our businesses are resilient and growing well. This was particularly evident from our sustainable performance during the peak periods of the COVID pandemic. Thank you.
Thank you so much, Alan. Great to get a good overview. Before you go into your question, Bright, I've got a question on my side. I see you've reported a 51.4% increase in your terminal sales. What is consumer spending looking like at the moment? What is consumer confidence? There's a lot of load shedding, lots happening. What are you seeing from your end?
There's no doubt that we have seen during the COVID pandemic that retail activity and tourism activity was obviously restricted enormously. But there's been a significant improvement in activity in retail outlets and particularly in the tourism sector.
Yes, we actually have similar questions, Keith and I. So I'm going to read his question on email. He says, what is your plan for the excess cash on your balance sheet? Keeping in mind, obviously, that payment companies in general, they're experiencing their own sort of winter, for a lack of a better word. And with that in mind, also, I want you to talk around, your Amsterdam office. Is that part of, the plan to maybe acquire something there? And how has the chip shortage impacted your terminal fleet growth? Because we know there was a chip shortage. I know currently it's reversing, but how have you guys managed to handle that?
Thank you. As I said in my presentation, our businesses are asset light and are very, very strong cash generators. So we are able to pay substantial dividends out of our businesses from operating cash flows on the one hand. But notwithstanding that, we have a very experienced executive management team that have been involved in acquisitions and mergers and acquisitions for many, many years in their prior careers.
Yes.
And we are very diligent and very cautious in the type of businesses and the prices that we'll pay for those businesses. And accordingly, we've had numerous opportunities to buy businesses, but we've only really been comfortable in making recent acquisition on the basis that the values of the business and their accretive benefits to the group going forward, as well as the fact that they synergistically fit into our culture and our ethos that determines the types of businesses that we will invest in. We are not in a hurry to invest the money, but we want to invest very wisely, cautiously and expeditiously in that regard. The question relating to chip and semiconductor shortages around the world, it's not unique to the payment terminal business. It's characteristic of the entire economy. There's so many different, like motor vehicles and many appliances and television sets, et cetera, are governed and dependent on those type of chip and semiconductors. So it has had a constraining impact. A significant feature is that notwithstanding it might delay our execution of orders, we're very, very fortunate that we've not lost any business over this pandemic period. What we have done is we've seen some delays in the execution of those orders.
Yeah. The other question is that, you know, the payment ecosystem in general is a forever evolving type of, you know, environment, and it's moving fast and it's changing. How do you think, you know, capital appreciation is going to stay on top of trends when it comes to, you know, software and technology?
Cash is still today the major payment methodology, not only in South Africa and in Africa, but in the world. Yeah. Cash is not being eliminated as quick as expectations from the experts globally. So accordingly, we are seeing a new emerging market segment where the use of cards on the one hand, or new type apps linked to our Halo development, that are evolving in what we call into the smaller and to the micro business sector, that are being predominantly cash generative. And accordingly, notwithstanding new payment alternatives are emerging, we're seeing that the growth in payment terminal market per se is growing substantially because new segment opportunities have been created. Yeah. In fact, when we bought the payments business in 2017, we saw the market at that time of about 350 to 400,000 terminals, and in the space of 4 or 5 years, we've seen it more than double in size, and it's continued to grow into those new segments of a market sector like the micro and small business sector.
Yeah, our final question, as a standalone business, are you making any profits on GovChat? I mean, I think that was an interesting and unique offering.
GovChat is a very exciting development for us. The platform is an outstanding platform. It was developed in-house by our synthesis business. Yes. And its operational performance and the millions and millions of users of the GovChat app and platform is indicative of the quality of a platform itself. We are very strongly involved in current processes of monetizing the GovChat in South Africa, but it's getting to a far wider reach in Africa and in the world. And working in tandem with our cloud partners, we are already seeing great opportunities emerge, not only in South Africa, in the monetization of the platform, but more so in the rest of Africa and globally.
Okay, thank you very much, Ellen. I had more questions, but I mean, we ran out of time now.
And please do keep those questions coming in online. Thank you so much, Ellen. Thank you for joining us in studio. To introduce our next company, Renogen is listed in the energy sector, has got a total market capitalization of 4.6 billion rand. And keeping with the SPAC theme, Renogen successfully listed as a SPAC on the Altex on the 9th of June 2015. And it was the first alternative energy company listed as a SPAC. They raised 75 million from Mazi Capital and Sanlam at that stage. Today, Renogen is an emerging helium domestic natural gas which holds the rights to rich renewable gas fields. Recently, Ivanhoe invested in the company, becoming a 4.35% shareholder. Stefano is in studio with us today, but first, let's cross over to their corporate video. Stefano, welcome to the studio. We are super excited to have you here. I have spoken to you quite a bit, and I know that you are up to a whole lot of exciting initiatives in phase 2, but why don't we let you give you an opportunity to give us an overview of where you are today.
Thank you, and appreciate the opportunity to be here and tell our story. So we've got a few slides on the corporate side. I'll try and be as brief through those as possible and rather have more of a Q&A session if you're happy with that. At an executive level, I think the one thing that has transpired in the last few months, particularly with the conflict in Europe, is that it's really brought into laser focus the strategic role that helium plays in our everyday lives. As such, it's probably one of the most strategic commodities that are out there, given its use in things like the manufacture of semiconductors, which is why there's a world shortage at the moment, because there's a world shortage of helium. It's the manufacturing of cell phones, laptops, cars, ironically, launching of rockets, MRIs. It's all of these different elements in everyday life that helium is absolutely critical to, and there is no substitute for it whatsoever. It's also a very rare gas, and it is in extremely short supply, and I'll take you through some of the touch points as to why it's in such short supply at the moment. Previously, the United States used to supply up to about 80% of the world's helium, and this stopped in 2018. This is because the United States had built this massive strategic reserve in Amarillo in Texas. It took them about 7 decades to stockpile this reserve, and they got to the point where they were auctioning off all of these stockpiled reserves. So over a period of about 3 decades, they literally managed to sell out this entire stockpile, leaving it at the point now where there is very, very little left of the stockpile. And now people have to find new sources of helium. So consequently, the price of the commodity has gone up. Touching on the theme that it's incredibly rare, it's found only in a handful of natural gas fields across the world, ranging from concentrations like in Qatar at 0.01% to the United States, who on aggregate have the highest concentration in the world at 0.35%. Our average is over 3%, and we've got wells up to 12%, which makes this the richest helium field in the world. Now we made a huge amount of progress since the first listing, where we managed to raise a whopping 75 million rand on the JSE as the first SPAC, and now we're busy turning on the first phase, which is a proof of concept plant that was financed by the United States government back in 2019, and that's because of the strategic nature of the commodity and its role in the modern economy. And we've also announced more recently that we're working on a phase 2 project and that we're working on the capital raising for phase 2. So from a helium supply perspective, you literally cannot make up what's happened in the helium world. So you've had a situation where not only has the stockpile started to reduce in how much is left in the stockpile, but to add to that, the plant that was producing this gas also went down. It's literally suffered a catastrophic failure. The plant was 80 years old and it's run to the end of its life, and it just broke down this year. It chose a really bad time to break down. It was still producing about 15% of the world's helium. That's now gone. They're attempting to resuscitate it. We don't know what state it's going to be in when it comes back, but it still doesn't have much of a life. Then to add to that, Qatar was meant to bring another plant on this year. That's been rescheduled for 2026 turn on. They also suffered temporary maintenance, unscheduled maintenance. So that's meant that there's been an additional squeeze on the helium market. The Russians were building a massive project called Amur. This was meant to be the world's biggest helium and LNG project. And unfortunately, that suffered some very serious problems. The LNG modules exploded. So that plant is now gone. And with the conflict, it's unlikely that they'll bring that back online anytime soon. Because of the conflict, Algeria has had to bypass the LNG liquefiers on its side and pump the gas directly into Europe through the pipeline. Doing that means that they cannot separate the helium. And so you've got a whole bunch of housewives and house husbands in Spain now cooking with high concentrations of helium in their gas. And the fact is that that gas is just going into the atmosphere. So Algeria has come offline. And then to crown it all, you've got this plant in Kansas, which just burnt down as a result of a random forest fire in the area. And that spilled over and caught the plant, unfortunately. So with all of these things down, you've got extremely constrained supply. And the elephant in the room is Hugoton. Hugoton is one of the largest independent helium fields on the planet, operated by Exxon, and it runs out of gas next year. At least that was according to the last update from Exxon. So the supply map for helium is not looking good. On the back of all of this, we obviously got the first round of funding from the United States government, and that was as a result of the strategic nature of the element. That was for $40 million to build the first plant, which is coming online now. They've come to the table and they've said that they're interested in participating in building the real plant. That's a $500 million check that they want to contribute. So we're going through the due diligence phase of this project now. And then in addition to that, we've had several banks come to the table and offer us additional capital. So from the banking side, on the debt side, we'll probably look to take on about $750 million worth of debt from the DFC and these banks. And that will go towards the phase 2 project. We obviously announced the Ivanhoe transaction, which they're interested in the gas for strategic reasons for the Platreef project here in South Africa. And then to combine the fact that we've also had the Central Energy Fund announce that they want to take a 10% stake in us at the asset level for strategic reasons to assist with the country's national strategic supply of energy to the country. So these are all significant tailwinds that we've had. From a company perspective, and you can find all of this on our website. It's reasonably well diversified, lots of shareholders on the books. I think instead of going through the rest of the presentation, I'd rather open up to Q&A, and you can find all of this or just email me directly.
Thanks so much, Stefano. So a question from my side. You on listing, like you say, a whopping 75 million rand on listing. What is the total capital raise that you're looking at doing now for phase 2?
So phase 2 is probably going to be somewhere around the final numbers aren't in yet, but we're looking at making some enhancements to the plant, and those enhancements should see revenue increase quite significantly. So we're probably looking somewhere around the billion, maybe a little bit north of $1 billion in total once we've made the enhancements to the plant. And then that'll have a corresponding increase in revenues quite substantially from what our current projections are.
Okay, we have plenty of questions. There's a lot of interest in the company. The first one says, in the debt and the Ivanhoe partnership imply that phase 2 will be a much larger project than initially expected. How much bigger that's the first question, will this increase in size drive strong returns to scale?
Absolutely. Look, the bigger the project, the more economies of scale you get. The capex is not linear. The capex is linear. You don't get economies of scale in terms of diminishing amount of capex per gigajoule of LNG that you produce, but your power requirements go down. So from an efficiency perspective, the bigger the plant, the way more efficient it is, and the better your margins.
Yeah. So
the scale of the project is going up. At this stage, it's looking like we're probably going to be somewhere in the region of about 44 million standard cubic feet of gas processed per day, which will produce about 34,000 gigajoules of LNG per day, about 5 tons of LNG per day. And then consequently on the back of that, probably one of the most important additions to this is the fact that we will vertically integrate within the helium chain by investing in our own trailers to move the helium around, which means that a significant portion of the helium that we're going to be producing is going to go into the spot market as opposed to the long-term take-or-pay market, which means that we can start to attract some of those healthy prices of around north of $2,000 per MCF, as opposed to the long-term take-or-pay of $250 per MCF.
Okay, interesting. You want to read the second question?
Yeah, we've got a question here from Desmond. And what he's saying is, Anthony Clark has a theory that Renogen may seek a NASDAQ listing in 2023. Now, obviously, you listed on the JSE originally. Second, you listed on the Australian Stock Exchange. What's the future plans?
Look, that old chestnut keeps doing the rounds. So I don't think that there's anything cast in stone. Yes, I think people can see from my Twitter handle that I travel to the United States a lot. Before anyone goes speculating too much, you need to understand we've got some US shareholders, we've got US lenders, we've got a product that's going to the United States. Yes, the United States happens to be quite a comfortable home for us. Does this mean that it's going to automatically translate into a listing on the NASDAQ? let's see. I'm not saying yes. I'm not saying no. There's a lot of water to flow under that bridge before anything happens.
Yeah, I mean, the business is, always raising capital, obviously, and there's a lot going there. Will you consider, for example, offering a much broader BE deal? Because I mean, considering that there's a lot of retail investors interested in the stock, it will make sense to raise extra capital using BE type structure.
So let's put it into context. If you're talking about the kind of Sasol and MTN type of BE deals, the capital that we're raising is a chunky number. So if we had to go that route, I'd be surprised if there was enough retail demand.
Oh, you've got a lot of interest, don't worry.
Yeah, but these are dollars now. These are not rands. This is a real check. Yeah. I'd be surprised if there was enough retail demand in South Africa for the kind of capital that we require for this project. Even just at an institutional level, institutions in South Africa typically tend to conglomerate around the top 100. Yeah. It's no lie. Yeah. It is what it is. So for companies such as ours, even though our liquidity profile is within the top 100, our market cap is nowhere near the top 100. So we're not, we're like Marmite. Either you love us or you hate us. And right now there are more haters than lovers. So this is a foreign story. This is not a local story.
Okay, so we've got another question here saying that with the Ivanhoe investment in the second subscription, is that on track? And with the third optional subscription, will that have a 30-day VWAP period as well?
So, I mean, the Ivanhoe deal is still in the DD phase, and that continues until towards the back end of July, if memory serves. So I can't really talk too much about the Ivanhoe process at this stage, but so far so good. On the CEF, also same thing. We're in the DD process over there. To answer the question relating to the VWAPs, yes, everything is always done at a market-related VWAP.
Okay, fantastic. I think you've answered both questions in tandem there.
We have one more question online. Stefano, this is coming from Shabi. When is commissioning phase finishing? That's the most important question.
Yep. So we are, we're obviously taking our time for the simple reason that if you went through all of the helium shocks in the system and you saw how many plants failed on startup, we don't want to be one of the additional plants that fails on startup. So we've been extra cautious. We've put inert gas through the system as opposed to putting live hydrocarbons through the system. We're purging the system. We're testing the system. We're retesting the system. A couple of days here and there on startup is negligible compared to the plant working. So we're not pressurizing the team. We are taking our time. Commissioning is, from a construction point of view, it's done. It's all there. We're just taking our time to make sure that when this thing starts up, we don't turn it off again and that it runs. So, we're not waiting months or weeks. It's close.
Okay, fantastic.
Right, any more questions?
No.
I've got one more question. Competitors. Who are your local international competitors and where do you see Renergen in the next 20 years?
So right now, with the helium crisis, and that's an answer that needs to be structured for both helium and natural gas. For helium, there's a severe shortfall. So right now, there are no competitors. There's just a demand to bring more of the gas online to sustain our way of life. So anyone that can bring helium online now, it's important that they do. With regards to LNG, the simplest way that I can explain this from a South African perspective is that we don't see any of the natural gas producers in South Africa as specifically being competitors to us. And the easiest way to think about this is consider an ideal world where you have one petrol station built in Johannesburg. You will have a bunch of cars operating in Johannesburg as a result. Now consider someone builds a filling station in Durban. The Durban filling station is not a competitor to the Johannesburg petrol station. You will have people coming and putting cars in Durban. But then you will have additional cars driving between Joburg and Durban, finding a business for that route. And so both of them benefit from it. The more people that adopt LNG and produce LNG online means that it becomes more of an adopted energy source.
Okay.
And so we don't see LNG producers as competitors.
Okay. 20 years from now?
Much bigger.
Much bigger. We've had one more sneaky question that has come in. So how much of phase one is in the helium spot market?
Unfortunately, none of it. That was all pre-sold. That was the condition for building the proof of concept. So phase one is done. It's contracted. It's wrapped up. There's nothing more to do with phase one. You just turn it on and the thing just operates. Phase two is where the really exciting stuff starts happening.
Great.
Interesting. We'll be watching it very closely.
We will indeed. Thanks
Thank
so
you.
much, Stefano. Thanks for coming into studio. Now to introduce our next speaker, to introduce Southern Palladium, who is listed on the basic material sector of the JSE, total market capitalization of 5.4 billion rand. Southern Palladium is an Australian public company which acquired 70% interest in palladium, rhodium dominant PGM project located on the eastern limb of the Bushveld in South Africa. The company recently listed on the JSE, and we've got Johan Odendaal, who will be telling us more about their developments since listing. But before that, let's cross over to the corporate video.
Managing Director of Southern Palladium. Southern Palladium just completed a successful 19 million Australian dollar capital raise for its Bengwenyama project. This comes at a time for us when the drive in the future green economy has sparked a renewed interest in the platinum group metals. The local Bengwenyama community is a major partner in this project and will certainly benefit from the development of the project and the listings on both the Australian Stock Exchange and the Johannesburg Stock Exchange. The project is situated on the eastern limb of the Bushveld complex. It's a shallow advanced exploration project adjacent to Tier 1 platinum producers and chrome producers. It has compelling geology with both the Merensky and UG2 on the property. We have an 18.8 million compliant resource and we intend to increase that in the near future. The intention is to develop this project within a period of 2 years, during which we will do extensive drilling, do a feasibility study and apply for a mining right application. We have an excellent team on board in terms of the management and board with good experience, and I'm quite confident that we will complete this exploration program within the desired 2-year period. We have around the property the necessary infrastructure, abundance of skilled workforce, and also the necessary service providers in the towns of Burgersfort and Steelpoort. This is a momentous moment for Southern Palladium and a good example of collaboration between business and community.
Johan, welcome to the studio. Great to have you here. A correction from my side. Your market cap, in fact, is 7 million rand. So apologies.
700.
700. There we go. 700. We've got that right now. Apologies on my side. It is great to have you in studio. The last time we saw you was at your listing event at the JSE. Please take us through your presentation. What's been happening since then?
Thank you, Patricia. And thank you for joining me today to talk about Southern Palladium's Bengwenyama project. It is a large project, a top-tier project, and with a solid partnership here in South Africa. I'm going to skip to the highlights of the project. It's a large project and situated in the eastern limb of a Bushveld complex. Compelling geology. We've got both the Merensky and the UG2 on the property. And we do have a community on the property, the Bengwenyama community. And this is an exploration project that we intend to develop over the next 2 years. And during this time, with the exploration, have a pre-feasibility completed and then do a mining right application. As Patricia said, we just recently listed on both the ASX and the JSE. And just to take you through the corporate structure, Miracle Upon Miracle is the rights holder, and it's 70% held by Southern Palladium and 30% held by a company called Neuronox, and Neuronox is 100% owned by the Bengwenyama community. The community also have a direct 12.3% stake in Southern Palladium. On the left is our share price movement, and that is in Australian cents, and with a total shares issued close to 90 million, it gives us 58 million Australian market capitalization and close to 700 million rands. In terms of our board, and that is on the MUM level, basically consisting of 3 members of Neuronox and 3 from SPD, so quite a diverse board on the MUM level. On the SPD level, quite an experienced management team with an outstanding track record. We've got 3 Australians and 3 South Africans on the board. Our chairman, Mr. Terence Goodlace, more than 40 years experience in the industry and has previously served on the Impala board and later became CEO of the company. Myself has been in the industry for many years and been CEO of Miracle Upon Miracle for the past 6 years. We also have a number of mining engineers with good experience both in developing of mining operations and also underground and open cast. Our exploration program will be run by a company called Manexcon, and it's a company that has also got fairly good experience in the industry and in platinum in particular. Just to take you through the project itself, it's located about 300 kilometers east of Johannesburg, and it is in the sweet spot of the eastern limb. And we are adjacent to Tier 1 platinum producers. Medikwa is just north of us, and further down, various other producers. We've got excellent infrastructure on the property, just adjacent to the property, water and power, and there's skilled workforce in Steelpoort and Burgersfort and also on the farm. In terms of our resource, we declared an inferred resource of 18.8 million ounces, JORC compliant in December, and there's a potential for an additional 15 to 34 million ounces on the property. So it's quite a large resource and a large project. The Pearl split, and that's Pearl split is the ratio between the various metals on 4E, is heavily weighted towards palladium and rhodium, and at the current prices, quite a significant proportion contributable through rhodium. The ore body itself is a typical bushveld, tabular ore bodies with both the Marinsky and the the UG2 dipping gently from east to south. The UG2, of course, will be the focus reef on this property, and that reef is typically mined at 4 to 4.5 grams per ton 4E. But the Marinsky, which sits at the top, has quite a wide reef, and certainly at the current prices, worthwhile looking at on a recognized basis. In the next 2 years, I believe there's quite a lot of news flow that we're going to see. We just completed a geophysics survey on the property. Next that we will do is drilling, and phase 1 drilling, and then go into concept study and feasibility study. From there, we will then embark on a pre-feasibility study and then finally do the mining right application. In terms of our drilling program specifically, as I mentioned, we just recently completed our geophysics, and it gives us more confidence in the area which we specifically want to drill, and that's on the eastern side. In our phase 1 drilling program, which is above 500 meters, and the intention is to drill 63 boreholes in this first phase, around about 25,000 meters of drilling. And the intention is to bring the inferred and exploration target into indicated, and through the pre-feasibility study convert into a reserve of approximately 2 million ounces. Our phase 2 is specifically focused on bringing the rest of the property into inferred, and that will be in the order of 12 borers that we will drill. Certainly, if we look at the outlook for platinum, we believe that we are operating in the green space, and in particular, in the last few years, the green movement in platinum has sparked a renewed interest in the platinum group metals. And if we look at the application of the platinum group metals, various applications in the production of hydrogen, autocatalysts, fuel cells, so quite a broad application that we see the platinums being used. Also in the use of autocatalysts in vehicles, we don't foresee a phase out soon of internal combustion engines, and it is something that I believe will contribute still to a significant amount of platinum use in the near future due to more strict environmental legislation. We look at the ESG side. Already at this point in time, we believe that it is something that we need to focus on. Of course, on the governance side, the SPD board brings to the company the necessary experience. On the environmental side as well, we're already looking at environmental to strict environmental control. But I think our important aspect is the social side with the community, and that is the focus of our ESG in the next year or two. Finally, if I can then just summarize, we are in the right location, absolutely, and we believe there is significant potential to unlock in this property. It comes to the market at an attractive value, and we've already seen uptick in the price. We are going to benefit from the green economy in the near future, and with our timeline of approximately 2 years that we want to do the exploration, we believe with the current management that we have, experienced management with an excellent track record, that we can do this. Thank you very much.
Thank you so much, Johan. Bright, I'm going to hand over straight to you.
Yes, we have a very interesting question here. It says, how much cash do you currently have on the balance sheet, and what is your cash burn ratio currently? What is your expected peak CapEx, and how do you currently envision powering the mines or the reefs, considering our current Eskom situation?
Yeah, I think in terms of our capital that we raised, we had a very successful capital raise during the listing and raised 19 million Australian dollars. And of course, what the intention is to use that capital for our exploration program. Just as an important note is that we are still an exploration company. So this capital that we raised will take us through our exploration program of approximately 2 years, and most of the capital will, of course, go into the exploration program. As a matter of fact, if we look at our capital, 70% of the capital that we raise will go into the ground, and in terms of the cash, the cash that we will apply, of course, will mostly be spent on the drilling, which we will do during phase 1, and that will stretch through a period of about 10 to 12 months, where most of the capital will go into. Okay. And then just in terms of a question on cash in our balance sheet at the moment is in the order of 17 million Australian dollars.
17 million Australian dollars. And in terms of alternative power, Eskom?
Absolutely. I think, in any mining company and in this industry need to look at alternative power. And we have a benefit of a new company to look at alternatives.
It's something that we will certainly address in our feasibility studies and also in the concept study that we will do is to look at alternatives. It's absolutely something that we will consider in our feasibility studies.
Yeah, you mentioned, your location, which is, some of the, best locations in South Africa and well sought after land. And you spoke about, introducing the community to become shareholders through the trust. And that's all and well, and it's amazing. We like that, and we like to see more from other companies. But, with ESG in mind, which is something you did mention, what is the estimated useful life of the current mines? And what are the plans or what are the provisions you have to put down in terms of refurbishing the mines once, the estimated useful life has ended? Because what we've seen, in our current environment is very sad, where miners just, offload these mines to other investors and make those problems, those new investors, problems, instead of actually actively participating in refurbishing those mines and ensuring that there's no, adverse gas that's, being excreted and being inhaled by the community, the, surrounding community, etc. And not just that, but generally, making the environment worse.
Yeah, I don't want to dwell too much on the life of this property and the environmental side as well. Those are something that we will certainly address in our feasibility studies. But just to give you an idea in terms of the size of this property, and there is certainly a lot of reports on our website where investors can go and have a look at, done by analysts. But just in general, if you look at this property, 20 million ounces in inferred with an additional 40 million ounces, it is a big property.
Yeah.
And if we just look in terms of our strike length and in terms of our down dip extension, on the first, just the first portion of the two farms, we believe that that will take us easily into 25, 30 years, and then you go into the next farm. So it does have a very long life, okay. And our intention is, of course, to develop this project through the various phases. But I think just one thing to note is that we are in the exploration phase. Don't want to dwell too much on the life. Those are the kind of numbers that we will now confirm in our feasibility study and on concept study.
Okay, thank you very much. That's all the questions I have.
Great. Well, Johan, recently listed, what has your reception been like here on the JSE? Have you seen investor demand for the share?
We've seen certainly investor demand in Australia. I think what we need to look at specifically on the South African side is liquidity, which we need to address and that we will look at. There has been a demand. We start seeing that coming through on the South African side. The initial intention or the initial reason for listing in Australia, of course, is, we did find that there was limited access to funds, specifically with our status as an exploration company in the South African market. That's why we tapped the Australian market. But I think, going forward, certainly we are now listed on the JSE, and certainly if we go and if we look at the various stages of this project, we will come to the market again at some point for capital. And certainly I think we will then tap on the South African market as well. Yeah. We prefer, and we've seen it, the South African market prefer a project which has completed its feasibility studies, and we will then be in a position to go to the market with those studies at hand.
I like that.
Any more questions? That's it?
No, that's
Great.
it.
Well, that wraps it up for Johan. Thank you very much for joining us in studio. Great to have you here. Now to introduce our next and last presenter and company for today's Stadio, listed in the consumer discretionary sector with a total market capitalization of 3 billion rand. Stadio is an investment company in private higher education, which originally unbundled from the Cura Group in 2017. The company says it is on track to achieving its 56,000 students by 2021. Interestingly, Stadio Higher Education purchased JSE listed Stadio holding shares for its postgraduate class of 2021. The Stadio Kulasi share scheme was aimed at creating a stepping stone for postgraduate students towards creating generational wealth and allowing them to become owners in the institution. Very interesting. We've got Samara, who is the Chief Financial Officer, joining us in studio. But first, let's cross over to their corporate video. Please don't forget to submit your questions and also to submit your information for the CPD point allocation. Let's cross over to their video.
The world isn't what it was yesterday. What worked then may not work now. What worked for others may not work for you. For Stadio, a qualification isn't just a qualification. It's more South Africans equipped with the education they need. It's more students inspired to reimagine their possibilities. It's an entire nation empowered. With 5 faculties, 10 campuses and over 50 accredited qualifications, undergraduate and postgraduate studies, contact, distance and blended learning, and a combined 100-year track record of excellence. We're transforming higher education into something that's truly multi-faculty, multi-campus, and multi-mode. Next time you think about what you want to do with your life, think about where you want to do it. This is Stadio, a new vision in higher education.
Samara, our second guest from Cape Town today, welcome. Great to have you here. Let's hand over to you so you can give us an overview.
Sure. Thanks so much, Patricia. And thank you for the opportunity to allow us to showcase our company. So first, I actually want to start off by talking about why does Stadio exist? And effectively, our main purpose exists to widen access to higher education in the country. So currently, we own 3 registered higher education providers, being Millpark Education. It's a distance learning provider that caters mainly to the finance sector. Then we've got AFTA, which is actually a contact learning institution specializing in what we term the creative economies, which is film, television, arts, and the like. And our third institution is Stadio, which effectively is a conglomeration of 4 brands that we had acquired. It services both contact learning and distance learning students and covers quite a wide array of qualifications. But if we look at a little bit about the stats that support our investment case, so over the last 20 years, we've seen the higher education sector in South Africa almost more than double, okay? And it's a sector that's growing or has grown and will continue to grow. And also over this period, what we've actually seen is that the number of school leavers that actually leave grade 12 with the ability to enter higher education has also increased. And by way of an example, in 2020, there were approximately 410,000 grade 12 students that actually qualified with the ability to actually study at a higher education institution. But only 51% of them actually accessed higher education. And the reality is our universities don't have the capacity to be able to fill this demand. And that's why we believe that private higher education providers can definitely play a role to bridge the gap in capacity we see in the market. Currently in South Africa, the private higher education sector is still quite small. It's only about 17% of the total higher education market. And we're seeing international developing countries that this participation rate is way in excess of 30%. So we actually believe there's a very big opportunity for private education in the South African context. Everything we do is actually underpinned by 3 strategic pillars. The first one is widening access. The second one is the world of work, and this is where we actually make sure that our graduates leave with the requisite skills and knowledge to be able to be participants in the working world. And the third element is what we refer to as student-centeredness. So everything we do always has the needs of the students at our core. We're a fairly new company. We were established in 2016, and between 2016 and 2020, it's what we refer to as the positioning years. And during this period, we acquired 7 brands. We also purchased various sites to expand, and we developed new programs. Between 2020 and 2022, it's what we refer to as the consolidation phase. And this is where we merge brands and launch the new Stadio Higher Education brand. We also really refocus the strategies of the Millpark and the AFTA brands. And we continue to invest in systems, processes, infrastructure, and the accreditation of new programs. And we find ourselves in 2022 really trying to embed the structural changes that we embarked on over the last couple of years. But what's exciting for us now is actually that we've created this platform of which to grow. And we really have set ourselves quite a big target. And we say we would like to target 100,000 students over time. And we're excited because we are now entering what we term the growth phase of our business. Just for a little bit of context, so currently Stadio has 38,000 students in South Africa and throughout Africa. And just again, in context, we are actually in the top 10 of the largest higher education providers in the country, and that's actually considering both private and public institutions. We also have a very far-reaching footprint, and we've got accredited sites in all the major centers in South Africa, as well as Namibia. But actually, 84% of our client base are actually distance learning students, which means that our students can access us from anywhere. We're also very proud of the offerings that we actually have on offer. We've got a nice spread of qualifications ranging from commerce and management. We've got a nice spread of qualifications in the education space as well as the law space. We're excited about the new developments that's coming in the IT space. And we really have a strong presence in the film, media, and design space. And as I mentioned, that is what we refer to as our creative economies. But looking a little bit at the numbers, we're very proud of being able to consistently grow student numbers over the last 5 years. If we look at our semester 1 student numbers, we've achieved a 10% compounded growth over the 5 years, and our semester 2 student numbers sitting at a 9% compounded annual growth. Also making up our students is what we refer to as our B2B business, which effectively is servicing the corporate training needs of many corporates in South Africa. Now, that business on its own, over the last 4 years, has actually been very volatile because we are actually subject to the training needs or the spending needs of corporates. If we had to extract the B2B business, what we see is the remainder of the business has actually grown at a compounded rate of 17% over the last 5 years. Pre-2018, a lot of our revenue came from acquisitive growth. Post-2018, we've actually very happy with the organic growth in revenue growing at a compounded rate of 20% to 2021. And similarly, over the period, our EBITDA has grown from 129 million to 310 million. But what's exciting for us here is actually the movement in EBITDA margin, where we've actually moved from a 20% EBITDA margin to a 28% EBITDA margin. And we really do believe that higher education providers or businesses can target EBITDA margins in excess of 30%. So we're on our way to that. In terms of the measure that we've used since we listed on the JSE in 2017 is what we refer to as our core headline earnings. And this is how we really measure our performance, which is effectively headline earnings that adjust for all the IFRS anomalies that come up from time to time. And we are very, very happy with our growth over the last couple of years. We've grown our core headline earnings 29% on a compounded rate, and our core HEPS at 27%. But what is very exciting about our business, and actually education businesses in general, is our ability to generate cash. And to the end of December, we generated 314 million rands worth of cash, which is actually over 100% of our EBITDA. We've also generated about 218 million rand of free cash flow. And the interesting part is we're actually getting towards the end of our intensive capital expansion, which was started with listing our acquisitive growth as well as our geographic expansion. We've got a very, very strong balance sheet. We are ungeared. We've got excess cash on our balance sheet currently. And, as a very young company, we're also very excited about the fact that, balancing the need to actually invest or reinvest in growth together with shareholder returns, we've actually managed to declare a maiden dividend of 4.7 cents a share. But why are we excited? And to date, or post 2018, all of our growth has come through organic means, which means that there exists, or there was, and there continues to be a very strong demand for our current programs that we have. But even more exciting for us is that we've identified a whole series of programs which we term high in demand programs that we are in the process of accrediting. So it will give us a nice spread of qualifications that we can offer. We also, through the launch of the Stadio Higher Education brand, have been able to really refocus on the optimization of our existing sites, putting new product on our existing sites as an example. And the distance learning offering for us is really a strong point in our business. Outside of UNISA, we are the largest distance learning provider in the country, and we really have a strong base of which to leverage off. We also maintain our prices very well and competitively priced, largely with the public space. And for us, we want to continue to be a lifelong learning partner to our students, where they come back to the institution, to study postgraduate, short courses. And Patricia, as you mentioned in the introduction, we actually launched the Stadio Khulisa share scheme. And maybe a little bit of a quick insight into our 2022 numbers. So we put out in our pre-listing statement that we wanted to target 56,000 students. To be able to do so from where we are now, we have to actually grow by 8% per annum, which we believe is very doable. And in 2022, we've grown student numbers by 11% for our semester one enrollments, distance learning growing by 15%, our contact learning down. But the very exciting part here is our growth in new student numbers. 16% for the period, and a growth in new student numbers actually forms the basis of growth in years to come. And I think just in closing, we really are proud of what we've set up from a distance learning operation. And we really want to be an alternative to UNISA, and we really believe that we can be an alternative to UNISA. And we're very excited about, going into this new growth phase and really looking at how we can make a meaningful contribution to higher education in the country. Thank you very much.
Thank you.
What a lovely presentation.
Thank you very much.
I've been following Stadio for a very long time now, since unbundling and getting those BE shares. Yeah,
we do have an online question from Keith McLachlan. He's got those questions rolling in today. A question that he has is, what qualifications are in the pipeline? And second part to that is, do you plan to reach 100,000 students entirely organically, or will there be acquisitions?
Yeah. So this is two separate questions, obviously, which also I had. He's reading my mind here. We know that in terms of accreditations, it's mostly commerce and the creatives, right? And you spoke about law for a bit, so I want you to expand on that. I mean, are we going to see engineers soon?
Yeah, so quite exciting for us is, so we've got quite a wide array, and I think, targeting the education sector as well, so that's actually been very, very positive for us. We've got commerce, which a lot of the private operators operate in. We've now taken to actually widening our law faculty, and what's very exciting for us is effectively we have one single IT qualification, and we're in the process of accrediting a number of different IT qualifications, which we can see is an in-demand sector in the country itself. So from that perspective, that's quite exciting. The engineering qualifications, we have submitted engineering qualifications, that's going through the accreditation process. And we're quite excited, with the potential to partner with some of the public institutions in really rolling out engineering qualifications in the country. So that's a new development for us. It's still early stages, but definitely in the pipeline. So over the next 18 months to 2 years, we're very excited about the opportunities to come.
Yeah, so now let's touch on the second bit. I mean, you plan to reach about 100K students, right?
Yes.
And you did mention that you're on your growth phase, but I'm a little bit confused because, you know, that's paradoxical in a way, because you're saying you're no longer going to, you know, grow to make as many acquisitions as you've done in the past 3 years.
Yeah.
But also you're saying you're in the growth phase of make that make sense for us.
No, so 100%. So we believe that our growth to 100,000 students can come purely from organic means. And by organic means, it means having the right products that are available. And that's why we use the term in demand. You know, so you can accredit a lot of programs, but if they're not what students want to, you know, to take up, you know, there's no use doing it. So we really look at, you know, where the needs are in kind of the workplace, you know, so where are people getting employed? What qualifications do they need? And we're really focusing on accrediting those and setting the base for that. As an example, maybe you don't know, so UNISA has 320,000 students, okay? So our aim is we've invested in, you know, site expansion, so we've set up largely our infrastructure to accommodate our contact learning students. And we believe the massive growth opportunity exists in the distance learning space. So for us is to actually make sure that we have the available products to be able to scale and grow. And the need is definitely there in the country. So as I said, you know, the number of school leavers that actually leave school but actually can't get into higher education. And even more so, that figure actually compounds every year. So you have this massive adult education market that hasn't actually accessed higher education. And with the distance learning offerings that are actually a lot more affordable, we believe that that growth will come organically. Now, obviously, we will look at opportunities that come across our table. So it's not to say that we will never look at acquisition opportunities. But in terms of the strategy as it exists now, our strategy is to organically grow our students to the 100,000 students over time.
Yes, and we've seen a lot of, you know, sort of the bigger, more established universities trying to, you know, in terms of accreditation, introduce a lot more of the digital type degrees. So digital, I'm thinking more social media and those, you know, like the marketing side of that. Yes. Does that fall under marketing, or is that something you do separately? Or are you looking to do in the near future?
So we've got an array of qualifications, okay? So those type of qualifications, which would actually be more, call it the media, marketing, advertising, will sit in what we refer to as our creative economies. So we don't have a specific marketing qualification, but we've got other qualifications in media, in design. You know, we've got a number of qualifications in fashion, and we've also, quite interestingly enough, launched the School of Architecture, which also sits in that media and design, you know, bucket, so to say. So we believe there is a lot of opportunity in the creative economies market, and as you say, you know, social media, digital marketing. We do have a qualification in digital marketing, sits squarely within that creative economies pillar.
Oh, fantastic. So you mentioned, you know, B2B being, you know, very volatile. So this is the first time I'm hearing it as a shareholder. So can you expand more? What's in there? What
yeah, so this would be, like, say, for example, a lot of the banks, short-term insurers that actually train their staff, and they actually put their staff on higher education qualifications.
Yes.
Now, we've seen over the last, say, 4 years, or maybe even pre-COVID, that, you know, corporate spend in training was a bit cyclical, you know, so that you would go through years where it would be very, very high spending. And then, you know, about 4 years ago, we saw that started to wane a little bit. And then obviously through COVID, what we saw is a number of corporates just put the brakes in terms of corporate training. But the exciting thing is, you know, what a lot of companies have realized, they've still got to train the staff, you know, so the staff still need to be skilled to be able to deliver on what the company requires. So we are seeing, you know, that training coming back. It's probably not back to where it was maybe 5 years ago, but, you know, that industry or that market is not dead. It's definitely still alive, maybe not to the highs that we were used to 5 years ago, but definitely a big portion and contributor to earnings in our business.
Yes, Patricia, do you have any questions?
I don't have any questions. How about you?
No, that's fine. So, I mean, I have to ask you this question. What are you mostly excited about in the future of Stadio? I mean,
yeah, so as I mentioned in the presentation, you know, it's been since we listed the company in 2017 and we've acquired a number of the brands. it actually has been a very hard slog, to try and coordinate, and bed them down. The change management was definitely bigger than what we anticipated. And really, we're starting to see those foundations now take root. So it's been a hard 4 years, of actually just really solidifying the foundation. And for us, is now we actually at the point where we can say, things are coming online, things are coming together, and that's why we're excited to move into this new growth phase of the business.
Yeah, so onwards and forwards to be bigger than UNISA.
Thank you.
That concludes the questions. Thank you so much. Thank you for joining us in studio. I'm going to put you on the spot, Bright. Good conversations, good discussions, thought-provoking questions on the companies that we've had. Any closing remarks from your side?
So, of course, you look at the different businesses that came and presented today. There's a mixture of quality. There's a lot of early stage type of stuff, so higher risk. So if you have to, create a portfolio and look at these businesses, you have to keep in mind of where they are in terms of their own journey as companies. So keep that in mind, and whether you have, the sort of stomach to well, not just the stomach for the risk, but also the time horizon to see these, projects come into fruition. So these investments are not going to be very easy, but I like the mixture of quality and I like the management and everyone is buoyant. And on that note, make good investment decisions.
Good. Yeah. Well, to our viewers online, thank you very much for joining us today. That does conclude our third Small Cap Investment Forum. Thank you to all of our speakers that joined us in studio today. Great presentations, again, thought-provoking questions. We really hope that you enjoyed the show. Please don't forget to send your name, surname, ID number to zia@iassa.co.za for your CPD points. And stay tuned for our next webinar, which will take place on the 14th of September.
One more question.
South Africa, one of the world's fastest growing and most diverse emerging markets. With world-class infrastructure, sophisticated financial services and a progressive constitution, it's a gateway to African markets and the ideal investment destination for global investors. For over 135 years, the Johannesburg Stock Exchange has been a pillar of the South African economy, delivering an uninterrupted trading, clearing and settlement environment. Through our multifaceted business model, the JSE trades multiple asset classes and offers core issuer and investor services from listings to benchmarks and settlement. Operating in such a diverse economy gives JSE clients access to a broad range of issuers across industries through multiple asset classes. We support the ecosystem with innovations like virtual AGMs, industry training, and Share Hub. We also offer secure, efficient secondary capital markets across a diverse range of securities. Through the JSE co-location facilities, clients can host their infrastructure at the JSE and access high-speed, low-latency trading and market data. Clients can access live JSE market data through our London-based International Access Point, which facilitates connection from almost anywhere in the world. Our direct market access process allows clients to participate quickly and easily in the auction periods and continuous trading periods. The JSE's integrated trading and clearing capabilities deliver real-time clearing, allowing members to use cross-market trading strategies on a stable, functionally rich platform. And our world-class infrastructure technology systems safeguard operational resilience, especially in uncertain times. The JSE also offers a complex order suite that provides a secure, non-visible and regulated channel through which to execute big orders. This enables competitive trading strategies and improves the efficiency of filing large orders while minimizing impact. A variety of market data products is available to market professionals and data distributors, which includes live, non-live, end-of-day, and historical data. We have nearly 170 indices across a variety of methodologies and investment criteria. Our joint venture with FTSE Russell includes a range of world-class indices. Other available datasets include bond ETP data, tick data for most markets via the JSE Tick Data solution hosted by the CME Group, corporate actions, business intelligence reports, valuations data, and live data provision via our IAP. JSE Clear is the settlement authority for exchange-traded equities and the clearinghouse for the exchange-traded derivatives market. It clears and risk manages transactions in securities listed on the JSE. We have created an environment that enhances sustainability and disclosure, maintains the highest governance standards, and offers innovative products that allow investors and issuers to act on their sustainability needs. As a leading global exchange, we co-create, unlock value, and make real connections happen. JSE, let's connect.